Welcome to the Unconventional Investor Podcast. I'm your host, Michelle Moses, certified financial planner, licensed realtor, and founder of Me Financial. If you're an accredited investor feeling overwhelmed by managing your portfolio and looking for alternative investment strategies that go beyond the traditional stock market, you're in the right place. Let's head into today's episode so you can start taking control of your financial future. Hello, everyone, and thank you so much for tuning in. Today, we are going to be talking about distressed private student loans, and we are going to be talking with Yrefy about this. And it is, I know that you could listen to this and possibly call Yrefy if you had a student loan, but we are going to be coming from this from a investment standpoint for accredited investors. And to talk about this, I have Laine Schoenberger here, and he is the Chief Investment Officer and Managing Partner at Yrefy. He is a former financial advisor who retired in 2017 to launch Yrefy. He's a graduate of and holds several certifications from the American College of Financial Services, including the Chartered Financial Consultant, Chartered Life Underwriter, and the LUTCF designations. And as founder and chief investment officer of Yrefy, most of his days are spent overseeing capital raise for the company, along with supporting the team in product design and implementation. Thank you so much for being here.
Pleasure's mine. Thank you for having me.
Yeah. So, Laine, we have to be totally honest. I met with you many, many years ago, right?
Been a long time.
Yeah, it's been a long time. I have always thought that this investment was very interesting, but then when I talked to people, they weren't that interested. You know, my set of clients were not that interested, but I have been, at meetings and things and heard your name and heard the company name. And so I'm really glad that you could be on here because I do think that this is a good investment.
Oh, thank you. I appreciate the opportunity.
Yeah. So you guys, Yrefy basically refinances distressed private student loans. So let's get that out of the way right now. We are not talking about federal student loans.
That's right. It's generally the first question we get asked is, well, can you refinance a federal student loan? The answer is no. We don't do any federal student loans. And really the question behind that is, what happens if the government forgives all the student loans? That's really what
exactly.
The
That's what's in the news.
Asking. Yeah. And at the end of the day, again, we don't do any federal, strictly private. And if there was some kind of forgiveness of federal, which I don't think there will be under this administration, but if there were, it would actually help us and it would help our borrowers. And the reason very simply is most borrowers that have private student loans also have federal. So if you free up the cash flow from getting rid of their payment, it helps us and it helps our borrowers.
Okay.
So we're not worried about it. It doesn't really affect us at all.
And so you're saying most people have both?
If they have
a mix?
They generally have a mix. If they have private, they generally have federal as well.
Okay.
Yep.
And so you're talking private loans. Is it more so they see what they can qualify for federally and then they kind of fill in with the private student loans? Is that the way that it works?
So they go off to school, out of college or out of high school and into college, and they obtain their financing one of many ways, one of which is they hit the finance office and it's a federal student loan first, the free application for federal student aid or the FAFSA app. Well, the government doesn't lend 100% of what you need. You also have your grants, loans, scholarships, et cetera, grants and scholarships rather. And then if there's not enough money or mom and dad or whoever hasn't saved it up, or you're not working, you have to go to the private side and get private student loans. So the interesting thing about those is they're still bankruptcy protected. They still have all the bankruptcy protections that federal student loans have. So when a borrower needs to get more money, that's their only recourse is to go out and get those private loans. They're credit-based. Most of them, mom and dad or grandma and grandpa, someone co-signs. So now they've gone to school and they're done. Now they're out in the real world, and that's where we step in, right? Because they've gone out, something went wrong in their world, whatever it was. It might have been, they got the job, but they had to start at the bottom and work their way up. Or maybe it took a little longer to get the job than they thought. And because of that, their payment wound up becoming delinquent and ultimately went into default. The problem with student loans, on the federal side, there's all kinds of programs to help people. On the private side, there is no real way out.
Okay.
If you go into distress on your student loan, delinquency first, you got your late payment, then you slip into the default interest rate, which is always double digits. And then you find yourself sliding down a very, very slippery slope where it's impossible to get out of. Now you're going to collections. They destroy your credit, mom and dad's credit, grandma and grandpa, whoever co-signed, and things start to get really ugly very quickly. And of course, they're moving towards collections, judgment, garnishment of wages. That's their recourse.
And what you say, when it's protected from bankruptcy, it basically means you can't discharge it in a bankruptcy. So with student loans, you can get rid of, or when you go through bankruptcy, you can get through a lot of things or have a lot of things discharged. But student loans, private or federal, are not one of those things.
Correct.
Okay.
Student loans and taxes are the two things you can't get out of in a bankruptcy.
Right.
Student loans, and I've had people challenge me, so I'll just let me put it out there. Student loans, the only way you can bankrupt out of a student loan is you have to go through what's called the Bruner test. There's 3 prongs. They're very, very hard to meet, and it's all 3. It's not 1 or 2. It's all 3. And it basically is, at the end of the day, it is 1,000,000% you cannot afford to pay this loan back. It's a burden, and you meet all of these requirements, which are really high bars to hit. Very, very few people have ever actually made it through the Bruner test and passed.
Okay.
So can you get out? Yeah, but you're living a destitute life.
Right.
Like under a bridge kind of thing.
Right.
It's bad.
Yeah.
So what we're doing is, borrowers were looking for a way to pay the debt back with dignity. We gave them that path, right? These are not borrowers looking for a free ride. These are borrowers that are, hey, I need a path to pay this back, and somebody please show me the way.
And so could you kind of walk us through like your process of what happens?
Absolutely. So borrowers, first and foremost, is really important part of this is they contact us. We don't do any outbound phone campaigns. Okay, they have to find us. How do they find us? Dave Ramsey endorses our borrower product. That's one. We do a lot of Google pay-per-click advertising. So they're online. They type in certain keywords. They'll find us and be driven to our website. There's also the relationships that we have with the lenders, servicers, collection agencies, law firms, wherever the debt is. And they'll actually do a live transfer of the borrower from their call floor to our call floor. So the borrower calls in. We explain our program. Co-borrower, if there's a co-borrower, if they're going to need a co-borrower, we explain the program to them. The process at this point is very similar to getting a mortgage. There's an application. We need to see tax returns, pay stubs, proof of employment, all the things that you would normally go through in an underwriting process. Now, we do pull credit. Here's the very interesting thing, though. We're pulling that credit so we can build what we call a student loan story. We want to learn about that borrower, their situation, what's happened, how they get here, where are they going. And with that, we can also calculate what their estimated payment would be with us should we fund a loan. We're not looking at their FICO score. We do not underwrite on FICO. We could care less what it is. And there's a reason. So we're building this story.
Well, it makes sense because if they're delinquent, then their FICO score would be in the... You're looking for more pattern than you are looking for the score. Yeah.
Well, we're looking for pattern, but more importantly, we're looking for their ability to repay us. Our number one rule is the borrower must be able to comfortably afford the Yrefy payment. Okay. And I'll tell you some statistics on FICO scores here in a second. So the borrowers now, they've applied. They're going through this underwriting process. We're able to calculate what their payment would be with us if we were to approve their loan. Well, they're required to set up an escrow account and start making that payment right now while we're underwriting them. They're going to do that for 2 to 6 months on average.
That's what I always liked about your investment was that they had an escrow.
They have to escrow. It gives us the ability to get to know them and them to get to know us. And frankly, it's the opportunity for them to prove that they have the willingness and ability to pay us back. Kind of important, right? So at this point, we haven't actually done anything with their actual loan other than underwrite it. Now, while we're doing that, we're working with the existing lender, servicer, collection agency, law firm, wherever that debt may be. We're negotiating down the price of the debt, which will ultimately settle and pay off at a discount, somewhere in 35, 40 cents on the dollar. We then refinance that back to the borrower for 100 cents on the dollar plus our 5% refinance fee. That's the only fee we charge the borrower. And we then give that borrower a custom tailored loan built around their ability to pay. Okay.
Yeah, are you talking about the terms? So somebody's might be 5 years, someone's might be 10 years.
Right.
Because you kind of have to drag it out. So the interest rate probably isn't what is the variable, but is it the time?
Well, both are the variables. So,
oh, really?
Yep, absolutely. Every loan is custom tailored. So these are not long-term predatory loans. These are short-term custom tailored loans. Our average borrower interest rate that we charge is 3.9 fixed.
Wow.
Average term right now is about 10.2 years. So we're not extending them out over their lifetime or anything like that. We want to get that term as short as we can to make it comfortably where they can afford the payment. And of course, that interest rate, we don't make our money on the interest. We make our money in the spread. The fact that we paid this asset off for 35 to 40 cents and it's worth 105. See, a lot of people stop and they say, wait. You just paid this loan off at a discount. Why don't you share that discount by taking the face value of the loan down? And we could do that. The problem is if you do that, the borrower now has a problem with the IRS, cancellation of debt income tax, right? They have to pay that difference in ordinary income. So we don't want to do that to them. We share the discount through a low fixed interest rate and a custom term. Makes the payment affordable, which brings me to that part about the FICO score and why we don't underwrite on FICO. Our average borrower comes to us with a low 500, high 400 FICO score.
Yeah, I believe it.
Not great.
Yeah.
Average co-borrower, low 600, high 500 FICO score. Again, not great.
Yeah, they're probably used to getting turned down for everything.
Yeah, there's no one out there that's going to give them a loan, much less a loan at terms we're willing to give them, right? So what we discovered, and this is an unintended benefit, we did not get in this business to fix people's credit, just to be clear. It was all about their student loan. What we discovered was within 6 to 9 months of us funding a loan, we're seeing average borrower FICO scores jump up 125 points and a co-borrower 138 on average. So that's significant. Like that's life-changing, right? So all of a sudden they become what other credit, other companies that are looking for people they want to loan money to, they become a good risk, right?
Right.
And all of a sudden they're now doing it right. And they see those huge increases because of how it's reported on their credit report. You've got a settlement, which used to be bad, now it's good. You got a payoff, which is good. You got a new loan created, also good. And then all those escrow payments hit, and now they're making regular monthly payments. So they see this big spike.
Oh, so at the very beginning of it, your escrow payments hit automatically?
Well, so remember, we're collecting those escrow payments for 2 months minimum.
Right.
We average about 6. We're not fast in underwriting on purpose. Right, we want to get these people to know. We want to know them. Get them to know us. We want to have a relationship before we spend any money on funding their loan. Right, so that's why it works. It's a thing of beauty because the borrowers are actually winning. They're getting ahead, and their entire life starts to shift. I mean, as a financial advisor, FICO drives everything. Right, their ability to buy a house, get a car, live a responsible life. Everything.
Yeah, and I would imagine that they feel like someone's finally thrown them a bone.
Yep,
there's finally something out there for people with a low FICO score that isn't in the 15% interest rate range or something like that. Yeah,
exactly.
Yeah.
So at the end of the day, it works, and then you have we say doing well by doing good, which is then we get into the investor side of this whole thing, which we'll talk about, I'm sure. But the really cool part and the story of this that I find the best is watching the borrowers win. I get to do what we call the borrower testimonials. I very rarely ever get to meet the borrower, but I get to talk to them sometimes on Zoom or phone or whatever. We're doing a testimonial. Hearing them and their stories, how they got where they were to where they are, it fills my cup. I mean,
yeah,
it's really
I'm
cool.
sure. Yeah.
But when you hear these stories of people who were kind of at the end of their rope, I mean, I can't tell you how many times I've heard the word suicide.
Yeah,
they're giving up.
Yeah, that they don't know where to turn because there is nowhere when you have a FICO like that. It's just like getting out of that is
impossible.
There's nobody that's going to help you out unless you've got a family member or a friend or something.
Yeah,
there's
win a lottery,
no way.
Inheritance, something like that.
Yeah, no one in the financial world is going to help you out. So this is where private credit comes in, which is what you have.
Right.
So that's wonderful.
Brings us to the other side.
Yeah.
Right?
So hold on, before we move to the other side, do you guys service the loans the entire time too?
We do.
You do? Okay.
We do. We service everything in-house. We've built all of our technology and software around the company intentionally because, again, it's all custom. So there's not like some software package out there that we could go get. Your bank, they loan their money. It's always, what do you have for a car loan these days? 3, 5, 7 years, and everything is it's all FICO driven. There's nothing out there. So we had to build everything to manage the whole company, which is great because it works, right? And at the end of the day, we do service. Now, you bring up a very good question. We offer a program to our borrowers called Skip 12. And Skip 12 is very simple. In the event a borrower has a problem, they can call us up. And this is the kind of relationship we want with our borrower, right? We don't want to have to chase them around. We want them to work with us. So they can call us and they can say, hey, I got this problem. Can I skip this payment? And the answer is yes. You can skip one payment every 6 months for a total of 12 times throughout the course of the loan. Interestingly, pre-COVID, nobody used it. I think we had 2 people use it one time. It was a nice little safety net that no one really cared about. COVID came along, and now all of a sudden you've got people that lost jobs, things happened. And this will also talk about this will address the issue of, how strong are these borrowers and how strong is the portfolio. At the peak of COVID, we had just under 23% usage of our COVID forbearance program. So these borrowers were not in default. They're not in delinquency. They just needed that month off. We basically extended our Skip 12 through COVID 1 month at a time. Didn't affect their Skip 12, but we just did the same thing. So we weren't accepting payments from those borrowers because they were out of work. Well, if they're not making payments, it feels a little like a default, right? From a numbers point of view. So we had just under 23% of our portfolio not making payments. And during that time, we still made every investor payment. That's how strong the portfolio is and how much room we have for, frankly, defaults.
Right.
Okay, so which brings me to the big question of the day.
It was a good stress test.
It's a great
for your
stress
investment.
test.
Yeah.
And we were much smaller then. This is all pre-COVID. We were only around for 2.5, 3 years before COVID hit. So it was a much, much smaller portfolio, and it did just exactly what we expected it to do. Now we're on the other side of that, and our portfolio is substantially larger, more borrowers, and it's just working. You know, we're getting noticed, right? So we're having a lot of fun watching these people win and get ahead.
Yeah.
So,
well, and I think that's what people are looking for too, is that when something goes wrong, they just want to take a month or two off. It's not, you know, and I think you saw that in 2008 with people's houses. They didn't necessarily want to foreclose on some people. They didn't want to foreclose on their house. Some people did. Some people took advantage of the system, but you know, some people wanted to work with the bank and they weren't willing to. Right. So I think this sounds more like what people would like, but that the industry doesn't really put up with.
Yeah. I mean, at the end of the day, there's always some we get to take advantage. But what we've done is we've ferret those people out on the front end through that escrow period, right? Because if they don't make the escrow payments, well, the other side.
There's some people that go through and they won't make the escrow payments. And so that's how you can tell.
Yep.
Okay.
Because we have a very simple rule, right? And when we're working with that borrower, we lay it out on the very first phone call. We're going to communicate with you. There's reasons you can fail. We're going to communicate with you. It might be via text, phone, email, whatever. We expect a response. In the absence of a response, we're not going to fund your loan. That's number one criteria. We got to be able to have a relationship here. Next one is escrow. You have to set up the escrow account, start making those payments. You miss the escrow, we're not going to be working together. We're going to give you back 100% of your money. You come back when you're serious. And you'd be really surprised at how serious these people are. And the ones that aren't ferret themselves out right at the beginning. First couple of months.
Really?
Doesn't take long.
Okay.
Yep. Doesn't take long.
Because so they'll make a payment or two and then they're just done.
Yeah, they make a payment, 2 payments, 5 payments, and then they start missing them. And okay, well, now we know where we stand before we ever funded the loan.
Right.
Right.
And then you give them all their money back.
Give them back all their money and say, call us when you're serious. We'll be here.
Okay.
You start over. Okay. Now, which brings up the biggest question of all. Well, how's it doing, right? And meaning, what's the default rate? How's our borrowers performing over the 8 years? Our aggregate default rate since 2017, when we started the company, hovers around 2%.
Oh, that's wonderful.
That's how well it's working. It's great because you're taking people 100% in default and putting it to a 98% success rate.
Right.
That's ridiculous. It's very cool.
Yeah.
We planned for a 10% default rate. That was back in 2017, we started the company. The 10% default rate fell right in line with the private student loan portfolios of the world, right? Like everything that's out there.
And you guys are at 2.
And we're at 2.
Yeah.
So we know these borrowers want to get out of debt. They're looking for a path. They just needed it.
They just need a olive branch or something. And This is it. Yeah.
Yep.
Okay.
Yep.
And so how big is your fund now?
Oh boy.
Is it one big fund?
It's one giant fund.
Okay.
It's, between our funded portfolio and our pipeline is growing very fast. We're sitting about $325 million now.
Wow.
We're growing.
That's
It's a
wonderful.
little over 2,000 borrowers in the funded side. And we're funding 10 to 15 million a month right now and growing quickly.
Wow. And are there other people that do what you guys do? I've never seen.
We do not have any competitors.
Okay. That's wonderful. Yeah.
We'll keep it that
I didn't
way.
know if anybody had ripped you off yet.
It's probably only a matter of time.
Yeah.
I will tell you, it's a very complex business. There's a tremendous number of moving pieces. So I would tell you, if someone knew how to do all of the things that we do, if they had the Yrefy playbook, right? Like I gave them the Yrefy playbook. If they had access to everything that we've built, it would probably take them a year to be up and running. There's a lot of moving pieces.
Okay. All right. So very, very unique investment. And so it's almost like you are looking for people on both sides, right? People that want to refinance, but then also people that want to invest, essentially loan their money to all of these people that want to refinance their student loans.
Right. So that's the other side of the business, which is the capital raise side. That's where I spend the lion's share of my time. So we built under what's called Regulation D 506C. So it's what's called an exempt offering. So it's filed with the Securities Exchange Commission. It's not anything beyond that. It's just filed with them. So we have a private placement memorandum. We have all the sales material, et cetera. What we offer is to investors, accredited investors, have the ability to pick and choose. Minimum investment's $50,000. You can pick the duration of your investment from 1 to 5 years. And you can mix and match. You can ladder income. It's really kind of interesting and neat what we built in that financial advisors, back in my day anyway, we used to build bond ladders and CD ladders and so forth. So we built this in that with that spirit in mind. So we have a 1-year investment that pays 6.5%. We have a 2-year that pays 7, a 3 that's 7.75, a 4 that's at 8.5, and a 5-year that's at 10.25. And what we do is we calculate interest daily and pay monthly interest payments to the investor, interest only. And at the end of their elected term or terms, they get their money back. Similar to a bond structure, it's not a bond. It's a promissory note. It just has a lot of the moving parts like that.
Of a bond, yeah.
A lot of people understand it when you say that, oh, that makes sense.
Yeah.
So then we went and we built all the software that drives all of this, the entire company. So we were able to get a little creative and say, well, what are investors looking for, right? Maybe they don't want the income. Well, if they don't want it, what are they going to do with it? Well, how about if you reinvest it or let it compound? Okay, you can do that. And what's really neat about it is in our software, you can actually go in and change your decision every month. So maybe 1 month you take the income, next month you don't want to let it compound. You can do that. Maybe you want to take 50% of the income or 12%,
oh my
whatever
gosh,
works.
You can do anything you want.
Anything you want.
Wow.
You can change it monthly, and you can do it by dollar amount or by percentage. So it's really a very intuitive product in that sense. And then we went one step further and we said, one of the problems in the alternative investment space is liquidity, right? And while we can't say we're a liquid investment, we can say we have a liquidity feature. And the way it works very simply is if the investor gives notice, they want some or all of their money back prior to the end of their term. What we do is we give that investor credit for the amount of time they've been invested as a percentage of what they agreed to. Okay. So first thing is it's at our discretion. So investor wants their money back. How fast it happens is at our discretion. We're not a bank. It's not going to be overnight. I promise that. It's never taken us longer than 30 days to redeem somebody. Okay. Because there's calculations that need to be done and statements that need to be generated and so forth. But we give them credit. So I always use the example because it's very simple. Let's say you're in the 1-year note. Okay. So 12 months, 6 months in or 50% of the way through, client wants their money back. They get to keep 50% of the interest up to that point in time. Okay. So if they were in for 80% of the time, they keep 80% of the interest and so on. The same thing applies on the 5-year note.
Well, that would make sense. So the 1 year is 6.5%. And so you're saying they'd make 3.25.
Exactly.
Okay.
Exactly. And we just have to do the calculation because it's literally down to the day.
Yeah.
Right. And that's one of the reasons we're not a bank. We can't do it like instantaneously, but we do move very quickly. We do carry reserves because we obviously want to make sure that investors, if they want their money back, we can do it quickly. But again, it's at our discretion. Okay. We won't put the company at risk or other investors or the portfolio at risk. If someone needed their money back, as we get asked all the time, well, what if there's a run on the bank? The proverbial run on the bank question. We line them up in the order you came in. That's the order we'll cash you out. So, and the portfolios generates a tremendous amount of cash flow. So it might take a month or two in the event we had to do it that way.
Right.
So.
Yeah, I get the run on the bank question too. And I'm like, well, if there's runs on the bank, we're all in deep doo-doo.
Chances are there's a lot more wrong in this world.
Yeah, there's a lot of other stuff going on that you're also going to be worried about and that we're all in the same boat.
Might be investing in lead and water.
I might be doing some other things. So I get those questions too.
Yeah.
Well, this seems pretty straightforward. I mean, there's not a whole lot hidden or...
There's nothing hidden. Nothing hidden. And, Michelle, we went a little further. We said, let's give the investor some more flexibility. And so we got our liquidity feature. Then we created what's called a roll-up. Now, as a financial advisor, that term gets used in a lot of things like annuities and so forth. The roll-up in our world is if you're in the 1, 2, 3, or 4-year note, at the end of your term, you can lock in all that interest. It's considered earned. It's the investor's money now. And they can roll up to anything above them and finish out that term at the higher interest rate.
So they could do 1 more year at the 10.25.
Yeah. So I use this example. Let's say they're in the 3-year note. They've been in for 3 years. They got their 7.75. Whether they took the money or let it compound, it doesn't really matter at this juncture. Now they say, gosh, I sure like this. I'd like to be in that 5-year note. I just don't know that I can be committed for another 5 years. Okay. We lock in everything at the 3. And in this example, we roll them from the 3 to the 5 and we'll give them 2 years at 10.25. If they had to get out in those last 2 years, we're going to calculate on a 2-year time frame, not on a 5-year time frame. Right. So and they can split. Let's say they were in that 3-year and they wanted to go 50% into the 4 and 50% into the 5 or 90-10 or whatever number.
Creating their own little bond ladder. Yeah.
Yep. So that's
a lot of flexibility.
There's a lot of flexibility.
I mean, you don't hear of alternative investments that offer flexibility like that. They're not interested in managing the investor's money at that kind of minutiae.
No, there's a lot of moving parts.
It is a lot of moving parts. And I really, I don't know, congratulate you or give you accolades for doing that, because most people it's very simple. You give us your money, and if you want it back, then it's at our discretion. And that's pretty much the talk.
Right. And you may or may not get it back.
Yeah.
Right?
You're in the pool, and congratulations. Here's your statement.
Right.
So yeah, this is a lot of thought going into what the investor may want, and a lot of flexibility for them, which is cool, because it's kind of like they have their money in a bank, and it's not, because I think what happens with alternative investments is that it's locked up for so long with, having lack of liquidity, that by the time you reach 5 years, they're over the excitement. There's no more excitement. They're done. They're ready to move on to something else that they can be excited about. Whereas this, if they're able to move things, and I would imagine that it keeps people invested for much, much longer, because they're able to manipulate it.
That's one reason. Another reason that people like to stay in is the interest rates are great.
Well, yeah,
it's a great story.
Yes, right? That so also.
We've got all these good things, and then you also add in the fact that this is what's called a non-correlated asset. We're not tied to the Fed. We're not tied to the stock market. Completely and totally outside of all that world. Yeah. So, people incorporate our investment into their portfolio because we get a lot of those calls where I'm fed up with the stock market. I can't do it anymore. It's too much stress. Okay, this is a fixed interest rate. The rates that we're offering that I gave earlier are all fixed interest rates. So we cannot go down. We can only go up. So, and we get that question a lot. Like, well, are you guys going to ever lower your interest rates? The answer is no, we can't, unless we offer a full right to rescind, penalty-free to all investors. Well, that's a lot of money.
Yeah, yeah.
Sure we want to do that. And we know that it'll work because the model's already doing it. So we know these interest rates are dialed in about perfect right now. I don't see us changing anything.
And they're good interest rates. I mean, I know people could nickel and dime you over things, and they will.
Sure.
But I think those are when they would go out and look at other private, I call it like private equity pools,
right?
Private credit. And you guys, private credit right now is, to me, where people, if people call me and they're like, what should I do with my cash? Private credit is where it's at. If you have cash that you can lend, with how tight the things are getting with the banks, interest rates. I'm not going to bore you with the whole thing, but a lot of banks are in a lot of commercial real estate that they cannot refinance. And so they're being really, really tight with credit right now. And so these private credit funds are becoming the answer. And if you have cash to lend, it is where you're going to make the most money right now at this point in time. I don't know about next year. I'm just saying right now.
It's a hot market.
It is a very hot market for doing private credit, which is, I have had other private credit type investments on here. And it's why I called you, is because I do think that this is kind of the way things need to go right now.
No, there's a bunch of them out there.
Yeah.
And there's some really, really great ones. And there's some other ones that you probably want to watch, be careful.
Yeah, you want to be careful of.
Like with anything, right? Every investor needs to do their due diligence. Even on Yrefy, do your due diligence. Make sure you're following through on, did you get all your answers to all your questions? Do you feel good about this? Did they give you the information that really matters? Or is it just a bunch of fluff?
Right.
And that goes for anything.
And does it match? I mean, some investors, they're like, I'm not going to invest anything for under 20%. Okay, well then this isn't for you.
Exactly.
You want something else. But I think for especially people going into retirement or in retirement, this might be something that's good and safe, and they know how much they're going to earn, and they like that.
Yep. And what's interesting is when you get into the private placement arena, by definition, they're all speculative investments. That's just how they have to be classified. And it doesn't matter if we had we don't, I'm not saying we do. If we had an FDIC wrapper on this thing, it's still considered speculative because it's a private placement.
Right.
I don't know that I can explain it beyond that. It's kind of crazy.
It is crazy. It's because you are going outside the bubble of being able to be tracked daily. Honestly, I really think it's anything that can be tracked daily and that has the scrutiny of the SEC and, all of the letters, FINRA and everything. Then it's like, okay, you're safe for the masses.
Right.
But if it's not, priced daily for some reason, it's really, really risky, and you need to be an accredited investor. And, the minimum is usually $25,000 to $50,000.
Exactly. And, when you bring that up, it's very interesting because you look at the things in the stock market, and it's almost like there's this aura that can't go wrong.
Yeah.
Well, I can tell you that there's
a lot that goes wrong, and people don't feel in control. And I think that's what people don't like.
Right.
And especially the people that really want into things like this, they're not all accredited investors, and they want to be able to get into it. So I wish I could help them out, but I'm just glad you're helping at least the borrowers out.
We're helping the borrowers.
Yeah.
When you're looking at these different alternatives, not just believe in their story, but believe in the widget, whatever the widget is that they've built. Right. This is not a case of, we've got this thing and you're going to invest in it for the returns. If you don't believe in our product, then don't invest in it. Right. If we were building, if we had a widget that maybe it was something you don't believe in, whether it's for religious reasons or ethical reasons or whatever, why would you invest in it?
Yeah.
Right. So whatever the widget is that you're going to look at, alternatively speaking, make sure that you believe in the product, not just it returns.
Yeah. Well, and that's what I always talk about with alternatives is that's what you want to invest in things that you're excited about.
Exactly.
And that you understand.
Right.
And that you're sometimes walking down the street and you're like, oh, I invested in that building in some way, shape, or form. So
exactly.
Yeah, it's kind of cool. And that's what people want now. They want that extra.
Yeah. When you're talking with your friends, right? I mean, people do this. They sit around and they talk about what they've done and what they're doing. And I invested in this thing. I don't really believe in it, but I'm getting returns.
Yeah. They're not going to do that. Yeah.
They're not going to do that. On the other hand, if this company has a good story and they like the product, they're going to talk about it more and they'll be excited about it.
Yeah.
Right. And that makes them feel good, makes the person they're talking to feel, everybody wins in that. So just a thought.
Yeah. No, I agree. And I'm really big on, and I tell this to some of my clients too. It's like, why can't we all make money together without ripping anybody off? I mean, it is
possible.
Yeah, it is possible. And I don't understand this whole mentality that someone has to get ripped off in order for somebody else to make money, because you can all make money together.
Correct.
It is possible. And there are beautiful things out there where there's examples of that. So
I agree.
Yeah. So I'm glad that you're doing it.
Yeah. Thank you.
Yeah. So thank you so much for being on. You guys, I'll have all of Yrefy's information in the show notes, but it's Y with a Y. REFY. So not WHY. It's the letter Y, Refi. And we'll have everything in the show notes. And if you have any questions, obviously you can call me or Laine and go to their website. And they have a pretty graph, or I should say graphic, with all of the returns of the 1 year through the 5 year. And you can kind of check it out.
Right.
Or if you have someone that needs to refinance their student loans, it's got both sides.
If you don't mind, I'll clarify because we've got two websites.
Oh, you do? Okay. I'm sorry.
No, you're fine. The borrower side is yrefy.com. Just letter Y, REFY.com. That's all for borrowers. If you go to invest Yrefy, you'll see the graphics on the investment side. There's a simulator there, so you can play with the simulator, all the good stuff.
Okay.
So, and if you do call us, please let us know that you heard of us on Michelle's show here, because it's kind of important.
Yeah, we'd love to know.
Yes.
So thank you so much for listening, everybody. I hope you got something out of this, and I hope you have a wonderful day. We will talk to you next week.
Thank you.
Thank you for listening to the Unconventional Investor Podcast. I hope you feel more confident in how you can grow your wealth using the strategies I shared in this episode. If you're ready to take the next step in diversifying your portfolio outside the stock market with alternative investments, head to mefinancial.net/contact us to book a 15-minute consult call with me. Let's discuss how we can work together to achieve your financial goals. Until then, I'll see you on the next episode.